Hello, everyone, and welcome to today's Bloomberg Roundtable, Investing in the New Energy Era. I am Ashish Sethia, Global Head of Commodities at Bloomberg NEF, and I will be moderating this discussion. Today, we'll be talking about the opportunities and challenges for the oil and gas industry in investing in the low carbon future. How do oil and gas firms and their investors balance climate risk, net zero ambitions, and financial returns? How can this industry derive value in the age of low carbon energy? Before we get started, some housekeeping announcements for our participants. If Zoom crashes, please close and reopen the application. If you're having any issues with sound or video, try refreshing your browser. Make sure you close all other applications and web pages to increase the bandwidth. If you need to get my attention, please click raise hand icon at the bottom of your screen. And finally, please use the chat box to network and exchange information with your peers. I would also like to take a moment to thank our sponsor, Schlumberger, for making this roundtable possible. Please welcome the Chief Technology Officer, Demos Pafitas, to provide a few opening remarks.
Ashish, thank you. Welcome, everyone. And thank you to Bloomberg for hosting today's session. Let me start with just a few high-level statements about what many now describe as the dual challenge. A forecast 40% real GDP growth by 2030, now combined with a goal to reduce energy-related CO2 emissions by the same percentage, is an ambition that requires the capacity to industrialize new technology at scale. And as the energy industry diversifies, there's a need to accelerate innovation in lower carbon sources, whilst also providing technology that reduces the footprint of the hydrocarbon industry. So how does the energy industry and companies like Schlumberger prepare to meet the challenge? For nearly 100 years, Schlumberger has been a company where new technology has been at the core, growing in scope and capabilities with a global reach and reputation for technical integrity and excellence. We're essentially a team of engineers, scientists, digital experts, plus our technology partners with a shared vision for solving the world's energy access challenges. So let me share a few examples. This year, we created a new business focused on delivering products, digital solutions, and services to identify, quantify, and reduce the world's emissions of methane, working with our own teams of developers and domain experts, and partnering with small and medium-sized technology companies. We rapidly engaged with early adopters, serious about identifying and mitigating their emissions. We also challenged our community of experts to make sustainability a focus for our broader portfolio of new product developments. And in 2021, we commercialized 20 new products, which we describe as transition technologies. Each of these essentially reduces the use phase emissions from hydrocarbon development and production operations. Now, it would be a mistake to think about only the impact of hardware, and there are material opportunities to be more efficient in the planning and execution phases of both existing and new energy projects. So today, Schlumberger is a leader in digital technologies spanning IoT, data science, and cloud-native technical computing. And already at this phase, our simulation and workflow optimization solutions are being used to plan geothermal wells, characterize subsurface carbon dioxide storage, and design surface process infrastructure. Finally, we're purposefully investing in developing and scaling new technologies where we apply our global engineering and manufacturing capabilities to partner with selected innovators. That topic will be the primary subject of another time, but we've made good progress in themes where we had both existing expertise, such as geothermal and CCUS, and in areas where we're a strategic partner on topics like lithium extraction, energy storage, and hydrogen. So to bring my preamble to a close, let me finish with a statement which we use to define our purpose. It's to provide the technology that makes reliable, sustainable energy available for all. So these are all examples of how focused investment in energy and technology companies that deliver innovation at scale will make a real impact in ensuring cleaner, affordable energy for people all over the world today and in the future. So thanks for listening. I really look forward to the conversation.
Thanks a lot, Demos. I think you laid out the basics really, really well there, and it's good ground for the discussion coming up further. Let's jump into the conversation. We have a lot to cover today, so in the interest of time, I would request all the speakers to introduce themselves and say a quick word about their role when they speak for the first time. So let me begin the conversation by asking the first question to Ravina. Ravina, in the last 3 or 4 years in particular, we have seen one after the other oil and gas companies around the world take a net zero target or have some sort of decarbonization ambition. Would you say these targets or ambitions are ambitious enough in themselves?
Thanks, Ashish, and thank you for having me. Ravina Advani, I head up BNP Paribas Energy, Natural Resources, and Renewables Coverage Team, where I essentially have sector and client oversight for the bank's energy businesses, which include oil and gas, power and utilities, metals and mining, chemicals, and commodities. And I think it's a great question, and it really depends. I would say that the net zero targets in all industries, including the oil and gas industry, are accelerating at rapid paces, which is really encouraging. And some of them are weak in ambition and impact, and some are incredibly strong. Where we see the strongest and most credible net zero targets, it's the ones that have interim science-based goals that provide guidance on how a target will actually be achieved and confirmation that it will be achieved before 2050. And furthermore, the stronger ones really addressed emissions across the company's entire value chain, including scope 3 emissions, which is emissions coming from suppliers as well as customers. Some of the oil majors that really stand out from my perspective are Eni, Oxy, Equinor, Repsol, and Shell. They all have very strong net zero commitments, and they all include scope 3. So it really does depend on what's included, what those milestones look like, and whether an objective can be achieved before 2050.
Ravina, a very quick follow-on question. Is having a scope 3 target, which is too far out in the future, let's say 2050, better or worse than having a scope 1 and 2 target, which is highly ambitious?
I think it really depends on the company and the industry. Scope 3, as we all know, is very hard to measure, yet it encompasses the lion's share of emissions, and it isn't mandatory for a net zero target. So I think it really depends on what that specific company is doing broadly around its emissions, where it's investing, where it's looking to retrench. But for right now, I would say the stronger clients, which is largely the European oil and gas majors, are really moving mountains when it comes to some of these ambitions and these targets.
Thanks, Ravina. So let me kind of take your last sentence there and ask a question to Chantal. Chantal, is there a difference in ambition between the European and US majors, but also difference ambition as you go around the world and look at nationalized oil and gas companies?
Yeah, thanks, Ashish. And very nice to meet you all. My name is Chantal Beck. I'm a partner with McKinsey based out of London, and I lead our work on oil and gas, energy transition, and decarbonization globally. And as you suggest, as we look at how oil and gas companies are responding to climate change around the world, we actually do see a different response to the European, let's say, majors like Eni, like Shell, like BP, versus what we see coming out of the US from Exxon or from Chevron, both of which in the US have put in place scope 1 and 2 targets, but they have through TCFD type requirements also reported the scope 3, but they have held back from making any type of scope 3 target. And we see a similar pattern if I look at recent announcements from companies like ADNOC or other Middle Eastern players, as well as Asia players. And I think it really comes down to the context under which these companies are acting. Many of them are responding to, their role within communities. And so where there is political pressure in one way or the other, they're responding to that. I do think that regardless of the targets that are set, we are, of course, seeing every company around the world really embracing what does it mean to my business if we move to a net zero world. And I think that was particularly strengthened out of the discussion at COP26, where you saw there was a commitment to reduce carbon, not in 2050, but in 2030 by 45%. And so these targets are not only becoming broader, but also, I think, more near term. And so you see increasing emergence of 2025 or 2030 type targets. Just to name an example, Chevron committing to 40% upstream carbon intensity reduction as an example. And we see increasingly that interim 2030 target as a means of forcing action now.
Thanks, Chantal. I think you're referring to what some people call now the decade of action. And so 2030 has become a bit of a flag post in some sense. I had a small follow-on question to you because you talked about the local context for various nationalized oil and gas companies in particular. There are countries like India which have taken not a 2050 ambition, but a 2070 ambition, right? Are you optimistic that people are underestimating the pace of change, particularly governments in developing economies? They're underestimating the pace of change, and we might get to the target much ahead of, let's say, a 2070 ambition.
Yeah, I think that's right. I think that, of course, countries around the world are trying to balance multiple constituencies. And I think part of what is driving, later out targets is the notion of ensuring a just transition. And you saw that come through in some of the COP language, where there was a bit of a debate about, full abatement of coal or reduced reliance on coal. I think until people see that this can be both beneficial to society and to carbon and to economics, people are reluctant to make too bold a commitment without understanding what the implications are, for example, on poverty or growth, right? If you look at China, who of course has a 2060 target, they're making massive investments in a lot of the new energies. And so I think as more companies around the world allocate significant amounts of capital, you'll start to see these cost curves come down significantly, which I think will start to give increasing confidence that certainly in many of these areas, like renewable in the power system, these are both good for the environment, but also very positive in terms of the economics of cost of generation, for example.
Thanks, Chantal. So let me head over to Josh. Josh, both Ravina and Chantal talked a little bit about the targets and the ambitions of various companies. Do you think the pathways to achieve them are clear enough right now, or we still have to wait for another 5-10 years for the whole set of technology to become viable, and then we can have a very well-defined pathway?
Sure. Thank you. Good question. Quick introduction. My name is Josh Hacker. I'm the Chief Investment Officer for OGCI Climate Investments. OGCI is a collaborative effort by 12 of the leading oil and gas producers for a collaborative reduction in carbon emissions from oil and gas. Climate Investments is the independent investing arm of that organization. We are backed by the 12 member companies, and we currently manage a $1.1 billion fund, which is focused on catalyzing and demonstrating climate solutions. So we currently focus on 3 deliverables: methane emissions reductions, carbon dioxide emissions reductions, and carbon dioxide recycling opportunities. In terms of the pathways, I think many of our member companies have already been mentioned by name here in the panel discussion. And I think collectively the organization has chosen to support the Paris Agreement and to work towards this collaborative approach towards a 1.5 degree temperature limit. I think we agree that there's no one solution and that this is a transition, but is the pathway clear enough? I think it starts with setting the objective, right? Setting the end post and the milestone to be achieved. I think each member company that we work with has a different set of assets, a different individual strategy, different regional footprint. And so it's not a one-size-fits-all transition or pathway, right? Some have chosen to continue with leveraging their current expertise, whether that be subsurface CO2 management. Others have moved into renewables. And I think you're going to see that as individual companies, they're going to continue to look for competitive advantage and to leverage their own strategies. I think we've got a lot of the low-hanging fruit identified, particularly in methane, some in efficiency and other operational efficiencies. But I also do think that as we move out towards achieving the objectives, as we look at scope 3, it's going to take new technologies and new solutions, and quite possibly those have not been identified yet.
Great, thanks, Josh. And we'll come back to, I think, a slightly more detailed conversation on some of these technologies in a few minutes. But let me go over to Brad. Brad, in the initial part of this conversation, a few different reporting structures have already been mentioned. And we talked about TCFD, we talked about science-based targets. What types of data and metrics should oil and gas companies provide in the reporting and disclosure so that investors feel confident enough of the pathways that they're taking?
Thank you, Ashish. It's a great question. I'll start with a quick intro. My name is Brad Wells, and I head up the energy investment banking team at BMO Capital Markets. In terms of data, I think what I'd share is investors are definitely pushing the sector to disclose more data with respect to their energy transition plans. Data that is more consistent, is more comparable, is more reliable. And it's clear why. This information can impact market value, right? The same way cash flows or assets and liabilities that are disclosed in a financial statement can. And we've seen examples of this that really run the spectrum from kind of the bare minimum required to what some would view as best in class. I would say what constitutes best in class disclosure from our perspective is actually a function of the company's sustainability and energy transition objectives. We really don't see a one size fits all here either. I think the right disclosure depends on the company's strategy, and those strategies do still differ across the sector, ranging from potentially just maximizing near-term return for shareholders by, I'll say, prudently managing the risks presented to their business by energy transition, versus potentially investing heavily to diversify and transition the business away from hydrocarbons to potentially outperform over the longer term. And so companies need to choose disclosure and metrics that match their strategy and ultimately allow investors, the market, to understand their execution against that plan. And I would say that the incentives for companies to be leaders in this regard, whatever that strategy may be, is the incentives are quite significant.
I'm glad you mentioned incentives, and I'll probably talk about disincentives a little bit later as well. But Ravina, follow-on question to you. How do investors work with oil and gas companies to ensure that targets that are being set are ambitious enough, looking at the core competencies of the companies themselves, and they are met continuously year after year?
Yeah, I think it's all dependent on how those investors are working with some of these companies. And as a financial institution, we are aligning ourselves with companies that are transitioning at a pace that we think is appropriate and in line with our own objectives around the Paris Accord. And so, what are we doing to continue monitoring these companies and ensuring they're hitting certain milestones? One, it's really understanding the narrative around these companies. Where are they headed? Are they looking to invest in mainstream renewables? Are they looking at innovative technologies? Are they looking to continue their businesses by investing in technologies like carbon sequestration and hydrogen? It's really understanding where they're headed. And what we're trying to do in terms of financial product innovation is come up with financial instruments that help some of these clients with their transition goals, with some of their transition objectives, including sustainable linked loans, green bonds. With sustainable linked loans, we're looking to ensure that they are meeting certain KPIs by a specific time frame. And if these companies are able to do so, they get the benefit in terms of pricing. Or conversely, if they don't, maybe there's a pricing premium or a pricing step up. So I would say that it's really dependent on each institution in terms of when can they bank that specific company, can they bank the asset class that's under question, and it's really understanding where these companies are going. And I think it was said earlier in this panel, I mean, one thing that is clear is that sustainability is very much part of the dialogue with the lion's share of our clients, regardless of whether we're talking to some of the national oil companies or the oil and gas majors, or even some of the private equity capital that continues to invest in some of the midstream assets and upstream assets and downstream assets. It's really about knowing your client, where they're heading, and then we can sort of back into what the appropriate financing looks like to help them with some of their transition and sustainability endeavors.
Thanks, Ravina. Chantal, a follow-on question actually to what Ravina said for you, which is, my team at Bloomberg NEF, as analysts in the energy and kind of mobility space, we have been observing that in certain parts of the world, even including in the US, some shale plays like Haynesville, the production from private companies is increasing while the production from public companies or publicly listed companies is increasing much more slowly compared to the private ones. How do we kind of capture all the companies in this space, not only the ones that are publicly listed and have specific disclosure requirements? How do we get to private companies and make them to act as well?
Interesting, really interesting. How, I think there are a couple of elements, right? I think one is every private company, of course, isn't the same. And when we look at family-owned companies, for example, let's take a Texas family-owned company, we see them as a sort of different segment than a classic private equity-owned company. And then, of course, public sector companies, different pressures, and then finally NOCs, different pressures. So I think that, how, to your direct question about how do we ensure that this is a transition that involves all companies in the oil and gas space, I think the key element is ultimately transparency on performance and at some stage differentiating product. Because when I look at, the oil and gas clients that we serve around the world, all barrels are not created equally. And we see that you have carbon intensity. Some of it is intrinsic in terms of, intrinsic advantages of onshore, low cost, low carbon barrels out of the Middle East, some parts of the Permian, certain parts of the North Sea, maybe less so parts of, other geographies. And so if you really want to drive differentiation, you need to, in my view, differentiate the product. Now that requires a whole system integration in order to have carbon reporting, carbon tracking, carbon transparency, and ultimately you'd need to believe that there is indeed some type of carbon pricing that would allow you to differentiate that product. Now we see some of those policies emerging around the world, like the California LCFS credit and 45Q in the US, which start to create business incentives for players to actually decarbonize or invest in that part of the decarbonization, because it actually makes business sense if you can get a carbon credit in California for $100 to $200. So some of those market mechanisms, public-private partnership, start to grab the attention of multiple players to actually act, right? So I think that's an important piece of the transparency that involves all players.
Thanks, Chantal. Brad, Chantal talked about differentiated products. The question I get a lot of times is, what's the market for differentiated products? And is there a potential premium that end users, let's say, energy company in Asia importing a fuel from US, pay for that differentiated low carbon product?
So it's a great question. I think the answer is yes, but that it's still very early stages. And it really comes back to the discussion we were having around the disclosure and the advantages of being best in class in that regard. being able to articulate that value proposition. It's very clear that pools of capital are chasing opportunities that are capitalizing on that right now. And so it's definitely early days, but we're absolutely seeing some of that differentiation come into play.
And Josh, is that also potentially a strategy for keeping market share particularly in areas where the overall demand might decline?
I think it is. I think, again, it'll depend on the individual player, but I do think data and metrics like a carbon intensity score where you can start to differentiate. I think the EU carbon border adjustment mechanism is another example, right, that is going to require and evaluate and score accordingly, and then of course translate to value and price in terms of differentiation. I think a big part of this is it all starts with really this transparency and this reporting according to standards. For us, I think a big part of that reporting is moving away from estimates and emission factors, which are misleading or sort of fall short maybe of incorporating best practices, and moving towards reporting based on measured emissions and measured energy intensity. And we do have the technology, right? The solutions are now available. They, in some cases, maybe particularly on the methane side, have been slower to evolve. But we've got a number, and I'm not going to speak to our own book here too much, right? But we do have a number of investments on the methane detection, measurement, and monitoring side of the business, which now have the capabilities at a cost-effective price point to be able to provide actual measurement data. And I think that's a big part of making that transition from estimates to actual measurements, and then incorporating that into the data and the reporting.
Great. And I'll come back to methane in a few moments from here. But before we do that, Demos, when you look at the kind of tool set for oil and gas companies for decarbonization, essentially two major options emerge. The first is reducing the footprint of existing businesses, and the second is investing in new ones. So what toolkit or solutions exist for reducing the footprint of existing businesses today?
Well, look, I think that's a very rapidly evolving story. And as I alluded to in my preamble, I think us, like many others that are product and service delivery companies, have been investing kind of rather vigorously in the last couple of years to position solutions all the way from well construction through to production on how you could, and I'll speak to the comments of the previous speaker here, how you can move from simulation to actually verifying a simulation with measurements that demonstrate when you substitute a previous generation of technology, it might be an electric submersible pump, with a new generation where you've really focused on the overall efficiency of that device, that as you start to add all of these things up, you start to see a substantial impact. And I think what I don't see yet, I should say, is I think across the world, be it IOCs, NOCs, independents, there's absolutely a different level of commitment at the highest levels. But I'll be absolutely convinced that this is going to get real traction and scale when I start to see it influencing supply chain decisions, tender responses, things like that. We don't see it yet filtering down uniformly across the world on those things. And I think that's going to be the tipping point in the next year or two, because as some of the speakers have already said, the financial mechanisms to both incentivize or penalties are usually not very good, but let's focus on the incentives. Once those are in place and well adopted, then people will start to take action all the way down to the grassroots. So I see lots of opportunity around, as I said, well construction, lots of opportunities around the production domain, and that portfolio of products is essentially ready to go over the past year and in the coming year. So nothing in the way technologically, I would say, to seeing those things really scale.
That's interesting, Demos. And one observation we have had is, at least in the last 6 months, we have seen some tenders, even in big consuming markets like Asia, where the importers are probably not yet asking for carbon neutrality for the products being sold to them, but at least asking for proper accounting and footprint measurement, which probably is a good first step.
Not to put too fine a point on it, it's a fantastic opportunity for those that are technology developers. Today, I can deliver for a customer at the end of a well, not just an invoice for services, but a carbon accounting score that today is a mixture of simulation and measurement. And in the future, I think that's going to have to be routine.
Sure. And Josh, going back to you a little bit, you talked about methane in the beginning. Obviously, one of the potential successes of COP26, if I may say so, is the global methane pledge, right? And seems like by and large there's consensus to tackle methane emissions. Do you think we'll meet the targets set there, or are you kind of slightly more pessimistic or optimistic on meeting those targets?
I'm always going to go with the optimistic view, Ashish. I think it's required in this sector that we play in, right? And so, I mean, I think the global methane pledge is a huge accomplishment for coming out of COP26, and a huge commitment by, I think, what is now over 100 participants, right? So, 30% reduction of 2020 methane emissions by 2030. I think it's certainly ambitious, but it really is, in our opinion, the area to focus on, right? We all know the carbon intensity of methane relative to CO2. But I think the solutions that we have at hand relative to methane emissions are much more tangible and known and proven and demonstrated, maybe relative to the carbon dioxide sort of side of the equation. And so I think, the global methane pledge plus the now proposed EPA regulations in the US on methane emissions, plus the anticipated and I think, just recently announced similar regulations in the EU, I think methane is really going to be one of the big and frankly the urgent areas of focus. And I think that's the piece that for us really is what's paramount to the broader effort here is the urgency, right? I mean, I think a lot of the net zero commitments, as people have alluded, are maybe similar in magnitude, but different in time frame, right? And understanding there's a number of factors and a number of other drivers for those decisions. But we as an organization, where we started thinking about 2050, we've actually pulled, much more near term in terms of 2030 becomes our metric. And so we as an investment firm are measured annually in terms of realized impact that we're able to deliver across our portfolio. And 2030 is our planned impact number. So that's really our out date. So there's this time value of carbon, this urgency that we are being driven by sort of day in and day out. And we believe methane is a big opportunity set. And I do think it's achievable, though it has to stay front and center. And we have to start implementing solutions today and tomorrow and sort of every day from now till 2030 in order to get those gigatons of available emissions that are out there each year.
That's interesting, Josh. One of the things I realized recently was a recent change in the strategy of the Chinese NOCs as well around methane, where they are trying to obviously in that country reduce the use of coal, if not phase out, at least phase down. And one of the strategies to do that is apparently increasing the shale gas production in the country and monitor and reduce the associated methane emissions with that shale gas production as much as possible. So it seems like, as you're rightly pointing out, there's action in the US, and perhaps positive action in the US after a little while, but also action in economies in Asia. So that seems like good news. I want to kind of move to a slightly different part of the conversation, which is capital availability. So Brad, we've been talking for the last few minutes about options that exist to reduce the emissions of existing oil and gas businesses. Is there enough capital available for oil and gas companies, particularly the leaders in the ESG space, to keep producing oil and gas and fossil fuels in the future?
So, I mean, if we go back to basics, as we've discussed, the world is going to remain reliant on fossil fuels for some time, and an imbalanced transition, trying to avoid that, is not likely to be the best path, certainly not a sustainable one. And as a result, oil and gas companies are on the front lines of decarbonization efforts, as we've been discussing, and they will continue to need funding to advance those initiatives, both with respect to reducing emissions from their existing hydrocarbon businesses and investing in some of the new technologies that the new sources of energy more longer term that we've been discussing. And I think that capital may come at a different cost than where it's come historically, and it may come from different pools relative to those that have historically been tapped. We talked a little bit about the private versus public markets, but ultimately the capital should be there if the return profile continues to make sense.
Okay, so that sounds pretty good to me. But Ravina, follow-on question to you. The energy crunch of 2021 has brought the question of just transition right into the popular media. And some people would argue that we have tried to solve the supply side of the equation much faster than the demand side. Demand for traditional natural resources and energy commodities haven't really gone down that much. It may take still maybe another 5-10 years for some of them to even peak. But there's been so much pressure on the supply side because of ESG matrix and investor appetite and so on, that supply is being curtailed to an extent. My question to you is, have you seen a significant difference in the cost of capital for traditional oil and gas assets? And if you think the cost of capital is going up, is it kind of going up at a pace much faster than the general capital markets are looking at?
Sure. And if I may just add to what Brad was saying, because I don't think every financial institution is created the same, right? I think a lot of investors have been turning their backs on various oil and gas asset classes, particularly when it relates to upstream or unconventional oil and gas, in order to support the energy transition and combat climate change. And I think, we at BNP Paribas, we are in that camp where we're being very selective on where we invest in the oil and gas value chain, given our alliance to the NZBA, given our PACTA reporting methodology when it comes to upstream assets. So I think it really depends on the institution and how far they are in their efforts to combat climate change. And I think there is a lot of differentiation when it comes to European banks versus maybe US banks, Canadian banks, and Japanese banks. And the reality is, if those asset owners aren't changing their strategies, these assets may become stranded over time, or even worse, these companies may not be able to tap the public or private markets to be able to access capital for refinancings down the road. And all of that is related to your question on the cost of capital. And I would say, yes, the cost of capital for oil and gas companies has generally seen an increase over the last 5 years. And it's for the reasons that we've all raised. There's rising ESG and sustainability concerns. Banks and asset managers are under their own pressure, which is stemming from regulators and their investors, because there's a demand and a desire for them to reduce or eliminate fossil fuel financing altogether. And then you have this national decarbonization initiative and the growing pressure to create actionable sustainability targets and depressed equity valuations for oil and gas companies. All of that has sort of contributed to an increase in the cost of capital. So I would say, yes, we are definitely seeing an increase, and it's sort of been that way for the last 5 years or so, regardless of whether you're talking about a corporate issuance or a project financing. Those costs have definitely gone up.
But put 1 + 1 together from what you and Brad both mentioned, it feels like capital can be available to oil and gas companies for traditional businesses, but you probably have to aim to be best in class in terms of your reporting standards, as well as your longer term ambitions on decarbonization to continue to raise capital, which in some sense probably is a good thing. Okay, cool.
Absolutely, absolutely.
Perfect. Chantal, you want to chime in that as well?
Yeah, I was just going to pick up on this theme of resilience, right? I think at least what we're seeing is that, number one, in the session that we hosted at COP, we had a bit of an offline discussion in the room. And one of the things that came up was that there's not a shortage of capital, there is a shortage of human capital, particularly as it relates to this topic. And that there was a lot of capital in the room, whether it was financial institutions or was private equity, saying, we're really keen on leaning in and deploying capital in the energy transition. We're looking for compelling teams and compelling projects that we can get behind to allocate capital. So I thought that was an important and interesting addition. I think the second thing, at least, that we're seeing is this notion of resilience. And that means if the total share of capital allocated to oil and gas, upstream, downstream, traditional, goes down, then it becomes about who are the winners that you're going to back that are low on the cost, low on the carbon, have secured end markets. And so I think that's the other piece of this is the resilience of the base business, but also the resilience of future strategy might incorporate scope 1 and 2 reduction, but also incorporates that strategic pivot, that frankly makes sense in the company context. So if I just sort of dimension at least a couple of figures that we've seen, right? If we say that $9 trillion will be required annually against the energy transition, about 650 billion of that is going into oil and gas. If you think about right now what's committed, publicly around new energies, it's a bit more at the level of 15 billion, right? So there's going to be over time this gradual transition that is substituting base business capex into these new value pools.
Demos, to just add on to Chantal's point, will it become difficult for oil and gas companies without a decarbonization roadmap to attract talent in the future?
Oh, I think that journey has already started. I think that there's no doubt about that. And I don't think I often hear this story described as it's a younger generation focus. I see this topic as enthusiastically debated and kind of driven by staff that have 30 years in the industry as it is with staff that are just coming in. And I think that's a substantial change. And if you don't have a strong message on this topic, and if you're not really investing, I mean, for us in technology that is aligned with that future, you won't even attract people. You're not invited to some university campuses anymore to attract the top talent. And I think that's a substantial change. Maybe a point that I'd like to make based on one of the earlier conversation points was that scale is hugely important even at this stage of the game. A lot of investment is happening, and rightly so, around encouraging innovators and startups and university spin-outs, and all of that is necessary. But if I just take the example of CCS, for instance, I think there are about 50 projects that are either active today or will soon be active, and they have a capacity to capture and store about 40 megatons. And what's the ambition by 2030? And I think you can debate, is it 2030 or 2040? It's almost moot, but it's a 200 times multiplier to get to about 8 gigatons. And therefore, finding those topics that may have some immaturity, but are truly ready to scale at a global level, that for me will be an absolutely vital step over the next couple of years. We haven't quite found all of those yet, I would just say. People are a bit reticent. And I think this is where, the financial markets need to make sure that they too are looking out for those things that can scale.
Great. Thanks, Demos. Josh, Demos talked about going from megatons to gigatons, which I totally agree with in our thinking. But if you're an oil and gas company, apart from reducing the emissions from the existing kind of fuels or existing business activities, if you're investing in clean energy, what are the most promising investment opportunities in your mind in clean energy for oil and gas companies?
Sure. I mean, I think this scaling question is sort of near and dear to our hearts, right? I mean, this is a big part of what we think about with every sector, subsector, and any specific investment we consider. It's what is the potential impact relative to the dollars we invest? And we do think about it both from a direct investment, but also as sort of an unlocking, a catalyzing. So I think to some of the CCUS projects, sort of that were referenced, or we have a number of investments in development stage CCS projects. And we're investing there because we recognize that, right, without the bankable example, right, that this cannot scale, this cannot go mainstream, this cannot deliver the tens or hundreds of megatons, which start to add up to the gigatons. And so that's how we view ourselves on the project side in terms of providing that catalyst and that scalability. So as we represent the interests of our member companies, again, it's a spectrum of strategies and a spectrum of points on this energy transition. So I think there are a couple of different, there are sort of almost seemingly countless opportunities in terms of how any individual player might proceed. I think there's typically sort of a historical bias towards the liquid fuels, right? So I think from an oil and gas perspective, thinking about alternative fuels, synthetic fuels, sustainable aviation fuel, right? Clearly that is one sort of strategic pathway that certain players in oil and gas are choosing to pursue. Others are taking sort of natural extensions of hydrogen production, which they may already be involved with for sort of within the fence production purposes, and thinking about the hydrogen transition as sort of an energy carrier. We're particularly focused in investment opportunities on the demand side of hydrogen in terms of how do we, again, as sort of someone looking to demonstrate solutions, how do we think about driving demand and new applications for hydrogen, and potentially more of a picks and shovels approach there. And then I think there's sort of, besides hydrogen, there's of course carbon capture. And again, certain players who think about their subsurface expertise and maybe their expertise with EOR and other applications with CO2 management, providing sort of a one step away from the core growth strategy. And then finally, I think there's the renewables and the power side, where certainly these are players who understand complex projects and assets, project management, sophisticated operators. That is sort of a natural extension as an adjacency to the core oil and gas business. So I think it is this range. And I would add sort of digitalization as a theme across all of it, right? I think we are seeing a lot of now sort of the AI enabled, the machine learning enabled, the big data plays. And certainly not every tool in the toolkit is going to be a SaaS platform, a cloud-based software solution. And I think that's part of maybe the realist in us, knowing that it will take software, it will take hardware, it will take steel in the ground, and it's a range of solutions that are required. But I do think, and I think we are seeing the embracing of digital as a way to enable scaling, right, and more rapid scaling, so that the computation and the data and the analysis that's required to think at that scale is possible.
Josh, you talked about the range of options available. One interesting nugget of information that my team at Bloomberg NEF gave to me recently was that if you look at the CCUS versus hydrogen debate, China has less than 5% of the operational or soon to be operational CCUS capacity, but it will have a 70% share in electrolyzer market globally next year. And so we're definitely seeing more momentum on CCUS in the US and more momentum on hydrogen in China, and even within the oil and gas companies within these two countries. But I think, as some people would say, all hands on the deck. So people won't pick their winners and go for one technology, go for it, and then some other country can deal with the other one better, perhaps.
Indeed. It depends where you start from. It depends the tools at your disposal, the regulatory construct, the policy, the broader stakeholder set, right? And of course, this just broader economic growth and development that we have to appreciate and acknowledge, right? And so depends where you start from, depends on the chess pieces you have on the board today in terms of the right decisions and the right strategies for your company or your country. As long as it's decreasing, sort of relative to the status quo and driving emissions down relative to both growth and sort of where we've been historically, I think it's all of the above, as you say.
Perfect. Demos, one quick follow-on question to you. In many oil and gas companies we work with today, there is an internal debate on whether they want to focus on clean electrons, on clean molecules. And Josh talked about sustainable aviation fuels, biofuels, CCUS, even hydrogen. And within hydrogen, there's kind of the debate between kind of gray hydrogen, blue hydrogen, green hydrogen, all the other fancy colors of hydrogen. How do you look at that debate? Are your clients kind of coming to you and saying, let's keep investing in technologies which get us more efficient and low on carbon in the existing business, or you're seeing more momentum on the clean electron side of the equation as well?
I think it's too early to say that one is becoming more dominant than the other. Undoubtedly, again, depending on the nature of the asset owner, their motivation to drive down the carbon intensity of extracting barrels is at different levels on the spectrum. That's kind of rather understandable. I think that, Europe, the conversation certainly about green electrons is rather more kind of buoyant, shall we say. But turning it into reality, it still looks like, at least for me in the short to medium term, a little bit bumpy if at the same time we need to avoid interruptions to, earlier on there was an allusion to, well, how do we make sure that the whole world can move on this story? Well, even in the developed world, you hear various levels of anxiety about, will the lights stay on during the upcoming winter? And you can hear from the way I speak. I went to school in England, and I can remember very well the 70s when there were power cuts at a national level. And I'm not too sure if we'll face that this year, but certainly in terms of making sure that both developed and developing nations can have uninterrupted transitions. This means that maintaining an insurance policy whilst going through big investments to scale up a green source of electrons still is very firmly on the agenda. I just described it that way.
Interesting. And I guess you've got to keep some good friends across the border as well, right? If you're in the UK, to get the fuels flowing. But Chantal, one quick follow-on question to you as well. Recently, there was a statement made from one of the European IOCs saying, we definitely see relatively high prices for oil and natural gas in the next 3-4 years. But we are not gonna use that as a reason to change our strategy to go heavily into kind of renewable power, the green electron, EV charging business. Does that sound like a fair strategy to you? And do you think others will differ a lot to that and want to make the most of high prices, let's say, in the next 5-7 years?
Yeah, it's an interesting question. I think the key thing that we see oil and gas companies thinking through is just the fundamentals of the value pool, and what is the growth rate that's expected and what is the return profile. And back to the point of the cost of capital, you see that a classic renewable project has a very different risk profile and therefore a very different cost of capital. But if you are an integrated oil and gas company, you need to be thinking, how can I get this pool of capital at this cost to unlock this particular project versus another, right? And so I think in some ways, I see the decision about whether or not to go into renewables as very independent from the gas picture. There's no doubt that there is going to be a huge growth in renewables. The question is, that value that gets created because of a lower LCOE value, who gets that value share, right? Is it passed on to the consumer? Does it reduce government subsidies? Does it actually become a value that accrues to the company? And that's a little bit what we're seeing, particularly when you have dramatically reducing LCOE costs on renewables. that make it very economic to substitute gas for renewables. The question is, how do you really create an attractive return for those renewable businesses?
Thanks, Chantal. And I do agree with you that when I used to look at strategies for oil and gas companies 5 years ago around decarbonization, a lot of that was around power and clean power. But more so, as both I think Demos and Josh have mentioned, the role of cleaner electrons is coming to the forefront, and you're starting to see not only kind of venture capital and private equity investment backing companies which can provide clean electrons, but even government policy starting to kind of look at options like sustainable aviation fuels and the likes, rather than kind of just purely looking at electrification only.
And maybe on that point, I would just say two things. I think the Fit for 55 policy has been incredibly compelling, as we were talking about earlier, on stimulating demand. So announcements that say, 10% sustainable aviation fuel, for example, in the UK by 2030. You look at the price between HBO or other biojet versus a syn fuel, it's a significant cost difference. But that catalyst from the policy on the demand side starts to give some companies confidence about whether or not they're going to go into those businesses. So I very much agree. I think a dual strategy on hydrogen, blue versus blue and green, with blue really being enabled importantly by tightly restricted emissions in order to really keep it certified as clean hydrogen, as well as that pivot, if you will, into syn fuels like power to liquids, for example, that can take green hydrogen and combine it with CO2, right? And these all kind of work together. I think what's interesting is if you have a gas portfolio, you can nicely pivot into blue hydrogen, and you can pivot into green as the market materializes.
Well, thanks a lot for that. And I think we have come to the end of the allocated time for this conversation. But I really want to thank all of you, because I think we covered a tremendous amount of material in the time allocated to us today. We kind of started by talking about whether the net zero ambitions are good enough for oil and gas companies. We talked about how to reduce the footprint of the current business. We talked about capital availability and its cost for traditional business activities, but we also kind of had a good conversation around what solutions exist and what technologies exist to reduce the emissions in the future. And we talked about investing in clean energy from oil and gas companies as well. So tremendous ground covered, and thank you again so much for joining. It was a pleasure hosting all of you today. Thank you so much.